today we have a person, a very eminent person from the academia to share with us her thoughts and ideas. She's Dr. Subhashini Suresh, who's an AMI in Electronics and Communication and an MBA and PhD. And she will be speaking on the topic investment options for new age investors. Very interesting topic. Let me formally introduce her to you. Dr. Subhashini Suresh is the Director of Management Studies at SNS Institutions, Coimbatore. She has over 10 years of experience in academia and over 20 years in industry. She has mentored industry professionals in the areas of business administration, insurance and risk management, data analysis, finance.
This meeting is being recorded.
Econometrics, statistics modeling.
The recording has stopped.
Corporate finance and portfolio management. Dr. Subhashini obtained her PhD from Bharatiyar University in 2015 in the area of finance. Apart from classroom teaching, Dr. Subhashini has been the chairperson of the Board of Studies and was involved in the framing of curriculum and syllabus and has served also as the member of governing body. She, as the chairperson of the research board, has undertaken various research projects and nurtured entrepreneurs and worked on projects sponsored by both state and central governments, like the EDI. She has undertaken consulting assignments and won 4 patents, written 5 books, published widely in international and national journals. She regularly contributes articles in Weekly Finance magazine as content writer and analyst. Dr. Subhashini is also actively contributes to seminars on capital markets. Welcome, Dr. Subhashini.
Yeah, welcome.
We really look forward to hearing from you. I welcome all the participants. Please, Dr. Subhashini, you may carry on. Yes.
Yeah, thanks, Mrs. Vandana Kumar and Nitin sir, Dr. Nitin sir, Dr. Ravindran sir, and all the CMA team for providing such a wonderful platform to me on this topic. Yeah, thank you, ma'am. I'll start sharing my screen. My screen is visible?
Yes, it is.
Yeah. So to the audience, it's a very happy New Year to you all. And welcome for today's session. Ma'am was saying that CMA is making a wonderful thing on every Monday musings. We hear a lot of speakers are on the platform and many people are able to gain the knowledge. See, we go to the industry, we gain an experience. That is the one platform which the institutions provide. But here, many experts are being over here and they are able to share with you. More than this, what a platform that you can get it. So I thank the CMA for providing this and contributing for the students community on this. So myself, ma'am has introduced about me. So I'm the Director of Management Studies in SNS Institutions, Coimbatore. And today we have a very interesting topic, which many people are looking at for what it is, what is something new in this, right? So here we talk about investments option for new age investors. So before beginning investments, everybody likes the story, right? So I want to begin with a small story. Which could be quite interesting, and why we do the investments. So there was a shop owner, and he was making business, and he was working very hard, and he was putting all the strategies and how to accumulate the wealth and how to do it, how to multiply it. He was doing all the strategies for training, and he was working on it. But
Nitin, please go on mute, please. Dr. Nitin? Yeah, okay. Ma'am, you can go ahead.
Yes, sir. So the shopkeeper was worried. Whatever I'm able to make it, I'm able to earn it. But at the end, I'm not finding very happier because I'm unable to save. Something is lacking with me, something on the planning or something is lacking with me. So what is the problem I have? He was just thinking it over days. Something is really a problem. Okay, let me go and get a solution for this. So he went to a hill, and there was a very good temple, very fine temple with a very good atmosphere. There was a saint sitting over there, and he thought, let me go and ask this person. He can provide me a solution. So he went, he climbed the hills, and he went nearby to the saint, and he got his blessings, and he told him, I'm looking for a solution. He replied, okay, son. Yeah, tell me, what is the problem that you have? See, whatever I am able to earn, I'm unable to save it. One or the other way, I'm just losing my money. I don't know what is the problem I have. So, but at the end, I'm not very happy. So, what is the problem that I have? And saint smiled. See, I'm a saint. I have left out all my belongings, and I become a saint. And you're going and up, you are asking me, and how do I earn, and how do I how do I accumulate, and how do I save for my future? How do you expect from me? He was just giving a smile. In a smile, he was able to understand. But anyway, as you have come and approached me, anyway, I need to provide you a solution. Though I cannot give it directly, but you can wait for some time. There will be some guests. So you can, we will have some solution from these three peoples who are coming over there. So he waited eagerly. Who are the three peoples? How is going to give me a solution? He was just waiting. At last, the three people came. And the first person, he looked at the first person, and he was so ill. He was so bad in his honest health condition. Okay, this person is going to give me a solution. And he was just thinking, okay. And he saw the second person. The second person was very sad. His face, his attitudes, it was totally, he was not so perfect. He was so sad. Something is a heavy loss under he came out. So he was unable to meet out his loss. It was such a kind of face expressions he had. He was so sad. And this person can give me a solution. He was thinking, okay, let me look onto the third person. The third person was very happier. He seems to be so healthy. He is so energetic. He was, okay, whether this person is going to give me a solution. So the saint just looked at this shop owner and told, okay, let me ask a question with you. And I have to ask a question. Why everybody are accumulating the wealth? And the three person answered on a same words they have repeated. It's for our stomach. We want to fulfill our stomach. It's for the half inch, the stomach. I need to accumulate it. Really? Are you accumulating the wealth for this alone? The second question, when it's popped up, the guys were looking at each other and they say, no, yes. Now the first person who was looking so ill, he told, when I became old, my health, I need to take care of my health, because at the old age, whatever the money I am accumulating, it has to take care of my health, right? So that's why I'm accumulating the wealth. Is it so? Okay, fine. Then he looked on to the second person who was very sad. He told, whenever I come across any financial problems, any troubles in my life, only this wealth is going to help me out. So I'm accumulating wealth for this purpose. He was doing. Okay, is it so? Then he moved to the third person. Third person was like so happy. He asked, what do you say on this? Why you are accumulating the wealth? He told, I need to take care of my house, my children, and if I have my excess money, I can donate it to someone else, and I can make them very happier by doing this. So the three persons answered in three different ways. And now the saint, he looked at this shop owner and he said, you got the solution now? And he was blinking. How do you say, sir? How do you say, saint? These three persons were answering in different modes. They were telling it. One person was so ill, the other person was so sad, another person was so happier. But my questions remained the same. It was not answered. Then he said, see, the first person, he started accumulating the wealth, saying that when I am ill in my old age, my money would fetch me. That was his intention. Yeah. The second person, he told, whenever there is any problems, it is coming across, whenever for financial crises are coming, the money is going to help me out. So he lost all his money. Now he is in heavy losses. That was his intention. Now it happened. And the third person, he accumulated his wealth in order to make himself and the others happier. And now he is so happy and he is so wealthy and healthy right now. So these are the three things. So from this, he told, not only the hard work, yeah, when you're accumulating wealth, but what is the intention that you have in your accumulating it? So when we say that, when I ask this question to everyone over here, the audience, let me pass a minute. Why you want to make an investment? So everybody has some answers. Like these three persons, they have different answer, right? But the one that we need to make is the intention. So I need to make an investments to make myself happy and to make others also happy. So if you're going to have that intention, definitely this investments, whatever you are making, it's going to help you out and it's going to be very positive for you. It is going to bring in your life and it's going to create a very good growth in your career. So the nature and God will definitely help you out when you're having a very positive attitude, very positive intention in accumulating the wealth. Yeah. So the basic, before starting investment, you understood why we need to make an investments. Yeah. Okay. Now let us get into the topic. So earning the returns for the idle resources. So whatever we have an idle resources, yeah, the money you take, the money you earn. So partially you spend and the rest you save. Yes, you require for your future expenses. Yeah, with a good intention. And some you save it right now and your savings may turn into your, yes, I require these savings for my future returns. Yeah, you say, and you make your investments. That is the first purpose of any investments you make. So you invest whatever you have, your idle resources, you think. From this idle resources, you're expecting their return from it. And in order to meet your specific goals in life, later it could be an education, later it could be an house. So whatever it is, the specific goal, it has to meet out. And you have to make some provisions for your future life for it, where in future, where your returns, you expect some returns out of it, where because we have, everybody are undergoing a very lifestyle. So in order to have the same lifestyle in your future, you require some money, right? So we do it and it has to beat my inflation. Right now, this is very high. We take that cost of inflation when we are talking about. So 6% inflation rate when we take for 20 years, if you're getting 100 rupees today, if I say it's not going to be the same. Yeah. So in 20 years, we can say this 100 rupees is about 321 rupees it's right now. So what is going to happen, my real return? So the real rate of return, we need to calculate it after inflation. And we ensure that it's meeting out and your investments, whatever you are making, it should be more than the inflation. There should not be any decrease in your value. So always calculate the real return, what you're getting it after inflation. Okay. So the next question comes in our mind is, when do I start my investments? Whether I need to wait for an opportunities? It's not. So sooner the better. As we tell, the 100 rupees today is not the same tomorrow, right? So for weeks, if you take, because the cost of inflations are very high. So sooner the better that we have to make the investments and we expect the growth out of it. And you have heard about the power of compounding. So these things will increase your income, as well as this income will provide you an interest and you will be able to make a better returns you can get it. So the golden rules, let us follow it. We have to make our investments earlier. And the second one is you have to make it regular one. Regularly, you have to keep investing on and you have to look for a very long term. Yeah, these are the golden rules. We'll take it up. So here comes so why we need to make an investments? What are the opportunities are available here right now? So if you take for the first 60 years, let us look into this graph, right? So first 60 years, our GDP was nearly around one single figures it was like. And next 7 years, what has happened from 2007 to 14, we had around 1.2 to 2.04 was our figure. And 8 years from in the period 2014, if you take up to 21, we were between 2.04 to 2.95. And now we expect in 26 and 27, we expect about 5 points. So we are going to become the 5th largest economy. So we are beating the UK, yeah, in terms of the GDP. So such a largest economy we are, such a platforms we are, where our investments are going to get so bigger, because our economy is so bigger and the opportunities are very bigger right now. Yeah. So what are the growth segments that we are trying to follow it up? So the first one, you take it off, that we know that we have, in the terms of age, we are saying that. So by 2025, we can see the average age, that is of 29, we are going to surpass the China. Yeah, which is for a longer period. We are going to beat the China right now in age, where we can find it is around from 18 to 64, where the working people's age are so higher in India, we are going to take. And when you are going to compare to be on the consumption side, our increases have fallen to 2.5 times from 2017 to 25. If you see, the consumptions has gone really right now. And what about we talk about digital India, the period of the internet? Yeah. So you can see we have increased from 450 million to 900 million users. Yeah. From the population of 1.3 million trillion, and 1.2 they are using of wireless, and 0.8 are using on the broadband. So what do you say on the telecom sectors? It has grown drastically, it has gone up. And when we talk about the financial inclusions, yeah, we are moving towards 100%, where every others are linked to the bank accounts, and the debit card users, it has gone from 30 crores to 90 crores, the debit cards has been issued. So what is the right of the strategy? It is about 90 crores there are, and the transactions are happening around 10x multiples, it's are happening on the digitalized. So urbanizations, when we talk about, so here by 2025, more than 100 plus smart cities are going to, we are moving towards the urban, we are going to move out, and the mobility, 150 million people are going to move from the middle class. If they are moving from the lower classes to middle class peoples. And the startups, when we say, the startups ecosystem. So we can have 1 lakh plus 150 unicorns are there currently. So such a business model we are happening it, and we can find there is an inter-country migrations are happening from West China to India. So on what are the areas they are coming on? On IT, on pharma, on chemicals they are in. And inter-industry migrations are happening in the same countries. We can say from in-house marketing to the in-house manufacturing to contract manufacturings are happening over here. And intercompany migrations are happening from public sectors to the private sectors we are moving across. And from one segment to the other segments we can talk about is voice to data in the telecom. We are talking about what are the value drivers we have in terms of technology, in terms of cost of capital, in terms of lower switching cost, in convenience, in innovations, and easier access to funding. So these are the various multiple opportunities are available before us. So how we are going to utilize these opportunities? Yeah. So coming now, how we can take all these opportunities to our investments. So let us understand about the basic investments option, which everyone are aware about it. So we can divide it into called as an financial assets, and one we call it as a physical assets. So the assets when we talk about are widely known as anything that has value and has return generating potential. That's why we make an investments over it. And every assets you own, what we say, we have an ownerships over the assets we have. So the financial assets when we talk about, it is arising out of the contractual claim. Examples you can take about the stocks, bonds, accounts receivable, company goodwill, copyrights, patents, etc. When we talk about the physical assets, so here we have the real estates, which are very identifiable, tangible presence we have. So the difference between a financial assets and physical assets when you take in terms of nature, yeah. So financial assets are intangible, physical lizards. Yeah, you have the real estate, you have the lands, you can feel. Yeah, those are all tangible. So what are the changes when we come across the value? So here, the market fluctuations, market price fluctuations, you can see in financial assets, you can visible, and depreciation and obsolete technologies are there in physical assets. In terms of liquidity, when we talk about the liquidity, yeah, it's very high in the financial assets. You can liquidate it at any time. You want to sell, you can sell it, and you can have your cash with you. Whereas in physical assets, it takes time because you need to find a particular broker, and you have to find about the land value. At least 4 or 5 buyers, you need to sit with them. So it takes time. You cannot expect the immediate liquidity over here in physical assets. And additional cost. There is no additional cost in financial assets you require it. Whereas in physical assets, yes, there are requirements for maintenance and repairs are there in you're going for the financial physical assets. And purchase value is very low in financial assets, whereas when you take in physical assets, it's high. So I can put you an example like in 99, there was a guy is purchasing HDFC Bank for 20,000 rupees, around 100 shares he's purchasing. And 2019, he's expecting to liquidate it. Similarly, he make another investments in physical assets. He bought some house for 20 lakhs rupees, and he's evaluating the value in 2019. So what would be the value? Any guesses? He bought HDFC share in 1999, and he bought a house for 20 lakhs on the same year. What would be the value when you're taking an example for 2019? What would be the value?
You can put in the chat or how you're expecting the answer, ma'am?
Yeah, in the chat, sir. I think there was one more chat. Yeah, I'll answer to him.
So you're asking which is lucratable?
Yeah.
Stock
so
or
what would be the value like which we can say the stock or the house, the appreciation, which would be higher?
real estate also depends upon the place, correct?
Yeah, it depends upon the place. And when we are talking about HDFC, might be if you take some other shares, we will not be gaining the same value. So the value was, yeah, I'll put it, it is around 57.50. It is around in house when you're talking about it was a 2 crore. When we are calculating on CAGR, it is like 33%. And for the house, it's about 12% we got it. And growth is 288x, and it is 10x multiples when you're talking about in the house that you do it. So again, here also it depends upon how do we look into the physical assets. Yeah, generating the value through a shares, it's quite okay. But in which company are we investing? We talked about HDFC. There could be other shares where the appreciations will not be there. So we have to see which financial assets are going to beat our inflation and how it is the substantial wealth is going to create us over the long term. So both physical, I don't say that only financial assets are very good, but in our portfolio, we have to have an investment pattern. Yeah. So someone asking, is a fixed deposit not good? No, you should be having it, the fixed deposits also in your portfolio. It is not that I say that only which are going to beat your inflation. So we need to calculate, yes, my fixed deposits are going to beat my inflation. Yeah, it's very good. So it is going to create value to you. Then you can make your investments in fixed deposit. That's nothing wrong on it. So make your investments on a diversified, have a combinations of financial assets and physical assets. When you're taking it in investments option of direct equity, you can find when a person is looking for a liquidity and he want to make quick profits and he is a high risk taker, then he can move on to the direct equity he can making, where he has to look for an investment for the 10-year period of a long term, and his risk reward ratio will be also very high on it. When you're taking it equity mutual funds, So it is a long-term investments option with a moderate risk because it is managed by fund manager, right? So compared to the direct equity, there is a moderate risk over here, and liquidity is also high, depends upon the funds option you have, and the tenure is a long-term, and risk reward ratio is also high. So when you're going to the debt mutual funds, it is very less riskier than the shares, you can say, and the moderate. And if you want to have a tenure like it, because you can have from money markets, there are so many things available for you from 1 day to 7 years itself, and risk reward ratio is a moderate over there. And PPF, so it is a safe investments for a longer term, and here your risk is very less and your liquidity is very low, and you have a 15 years of lock-in period over here, and risk reward ratio is also a little bit less. So when you're going for the fixed deposits where you have a lump sum investments, and so it is good for the persons who are under retirees and they want to have a very low risk profile, they want to have it, they can do it, and you have them days from 7 days to 10 years, and for moderate. The second one is on the gold, you can have it, so which is getting hedged against the inflation. So 1 minute. My screen is visible, sir?
Yes, it's visible. The investment option slide is there.
Okay. So you have this gold. If you're making an investment on gold, it is hedging against inflations. You want to hedge against it, so you can make your investment where the risk level is very low and liquidity is there, and it's for a long term, and risk reward ratio is also high over this. So you can have a diversified portfolio by making it depending upon your tenure and depending upon your risk reward ratio. You can make your investments onto this physical financial assets and fiscal assets. With a combination of this, you can make it. So what are the asset classes we have and what are the financial products we have? So coming over here, we have the fixed investments you can have in fixed income. You have fixed income mutual funds, fixed deposits, bonds, and P2P lending, PPF, portfolio managements. You have and the categories. And public equities, you can invest onto these stocks and shares, equity mutual funds, ETFs, gold ETFs, you can invest onto it. And private equity, you want to invest on an unlisted shares. This will be covering about it here. What are the other alternative assets that we are going to have it over here? And you want to make a global equity, you can invest onto it, you can make. And real estates, you want to make an investments. And gold, there are different varieties of golds are there. Not only in physical you want to invest, you can invest onto the gold ETF, digi gold, you can invest. These are the various financial products which are available in the market. So as I told you, based on your tenure, based on your risk profile, you can diversify your investments onto these categories. And the one interesting fact you find out in these asset classes are, it is not the same for every year. You can find the variations are happening. So one time you can find out the small caps are doing well. The other time you can find out the large caps are doing well. And the debt funds are doing really well. And gold is doing really well. So what we understand from these variations are, the winners among the asset classes are keep rotating every year. It's not going to be the same. So 1 year you can find, yeah, this is better. The other year you can find out something is better. Other than this are better. You can find the real estate, you can find GSEC, you find T-bills, corporate bonds. These are doing really well. So we need to have a combination of these when we are going to have our financial planning. So Indian equities, you talk about it, have been an outperformers, we can say, about the double-digit figures when we are comparing into the global markets. So in spite of, we had the high inflation, interest rates, currency swings, and geopolitical uncertainties were revolving, but still our Indian markets were doing better. And we expect higher volatility, like in equity terms, we expect there was a very high volatility were there, and it might continue as per the experts, and is it very important asset classes in order to beat your inflations compared to the others. So having equity as one of your portion is very good. And coming to the debt, so if you can find out the rise of yields are getting impacted on the debt instruments as price of bonds are getting decreased and yields are going up. So the yield jump is very lower when you are taking it in the lower duration funds and maturity period. So here we need to match our investment horizon with the portfolio maturity that we need to match. Are we going to invest on the short term or are we going to invest on the long terms? So based on it, we need to select on the debt funds. And if you're going to invest onto the corporate bonds and PSUs, we need to make like 3 to 5 years durations that you can have it. And government securities, it's adjustable to hold it till it maturities also. So coming to gold, so the gold reputations, as we saw, it is a hedge against the inflation, and which has been a very top performing, and you can find out it is around 11.3%, around 12% in dollar it was like. And gold is a very good diversifications, and it is going to reduce your volatility, and it is good to have it in one of your asset classes also. Real estate, yeah, real estate, there are rising demands over here. And as we saw, more people are moving towards the urban, and the prices are getting raised by around 3 to 5%. You can find there are increase on your prices. And it is not that only you have to make your direct investment on plan. There are other sources also that will see how to make an investment in all these platforms too. So portfolio diversification and decorrelation. So we have been saying when we are investing on equity, so whether I have to invest on equity only in listed companies, can I participate in an unlisted companies also? So because there are many opportunities are going in this unlisted companies. So how do I make the diversifications? So investing in unlisted companies is going to help us to improve the diversification of your investments and portfolios, and make it possible to naturally achieve the decorrelation from stock market cycles, because we saw equity markets are more bound to these cycles and the volatility. And I need to have some investments that is decorrelating with my equities. So how do I make it? So the investor must be prepared, like when you want an asset classes, which is having not correlated with the markets and less volatility. So there should be a commitment that I need to make, as I told in the golden rules. I should make like a long-term commitment I need to have. Since this type of financing takes several years to realize to the full potential, so I should make a commitment that I need to do it for a longer term. So in return, what I'm going to get rewarded with a very higher annual returns with annual performance in the double digits. I'm going to get it. So this is one of the very good asset classes what we are talking about. So how do I participate it? So we say it is an unlisted companies. Yeah, growing number of companies are no longer, you can find they are not listed on the stock exchange or not being listed later than before. Yeah, so the value created by these companies is increasing outside these stock exchanges. So how do we participate in these companies which are not listed? And investors are involving in financing and growing these companies through the private equity investments, and which is also known as the investment capitals at different stages of growth, Adi. So how do I participate in these investment, the companies which are growing right now? And how do I get it? And how do I make it? It's one of my asset classes where it is decorrelated with the equity. So here comes the alternative investments. So what are these always, why it is getting popular? As we can find, traditional investments are like it is pooled one. Yeah. And they are facing challenges in product innovations, in differentiations and alpha generations owing to the size and the other factors. So the people they want some innovations in their product they want. Yeah. So these conventional investment product charges mostly serve on trading. So you can find all these stocks or equity, some of the other, it is coming under the trading classes. So investments are now, they are demanding it for like alternative investments, which the areas are remaining unfilled. Yeah, that's why we have this topic, which are the asset classes that we can have in my portfolio. Because of this increasing demands and innovative offerings and the way they have differentiated and the vertex style of how do I manage my risk and rewards, this AAF are becoming very, very popular now. So what is these alternative investments are when we talk about? So alternate investments are the assets other than the traditional investments type. So you can say the stocks, cash, and bonds that we have it. And alternate investments differ from the traditional. Yeah, how it differs are, it is based on the complexity, based on the liquidity when we take, and regulations, based on the mode of fund managements. Yeah, in all these areas, it is differing from the traditional investments. So how do I achieve my portfolio? By investing onto the alternate investments, because we say it is so complex and liquidity part, and it is not much regulated and mode of fund management. We need to take on all these aspects. So what are the types are there in these alternative investments? So we have about like private equity we call it. The other class, we call it about hedge funds, venture capital, real estates, and collectibles. So here, when we talk about the futures of these are, it involves high minimum investment. So when you want to make alternate investments, it's not like there's as you use in equity or as you use in your mutual funds. So here it involves a very huge amounts are involved on it. And it is a very low liquidity about it. And it may prove fraudulent too. And normally when we say it is a long-term investments, so we take about 10 to 15 years. And the transaction cost compared to the traditional investments, the transaction costs are very, very less over here. And this effective techniques of investing onto the alternative is going to minimize your investments, and it is going to reduce your correlation that we can say to low to zero or decorrelations when you're comparing with your traditional assets. And it would be a best option to have it in your portfolio diversification. Yeah, they have some tax benefits too for making your investments onto it. So going on to this, the private equity, let us see on all these classifications. So it is a very low correlations compared with the traditional asset classes, and it is going to enhance your risk return profile, and it is going to increase your income towards through the higher yields in low interest periods. It's going to provide to you and high expected returns, and it is a very low volatility. So these are the various futures that you have it on it. And we can include in this also the real estate and commodities, which are a very old type of investments. That also comes under these alternative investments. And alternative investments, it includes a non-traditional approach to investing within a specific vehicles. As we saw in a private equity and hedge funds, they will be investing on it. And these funds gives a manager the flexibility to use the derivatives and leverage and make investments in illiquid assets and to take short and long positions accordingly to generate your returns. So the lower liquidity, risk regulations, lower transparency, and the long-term commitments that you have onto these funds. So these makes it very look attractive when you're comparing with your traditional investments. So when we take on the endowment portfolio, they nearly invest about 33% are invested onto the AAF. And you take this in yours, we have the average family office portfolio. They are doing about 40% of their investments are allotted to this AAF. And when we talk about the global asset management, so 23% they are doing onto the AAF. So these are the various funds. The fund managers are looking on to the opportunities in AF, and they started investing on it, on this. So here they have divided into the various categories. So we have the 3 categories classes according to the SEBI regulations we have it. So it is category 1, category 2, and category 3, which has been divided into 3 category classes. It has been divided. So the first category, if you want to invest in AAF, so there are 3 categories in front of you. So you have to select in which category of fund that you're investing on. So when we are talking about the funds that you invest in small and medium enterprises, you're looking for a startup and new business which are having a very huge potential and are economically and socially viable, which comes under this category. So here the government encourages the entrepreneurs to invest onto these products, to these projects, and as they are not only contributing for the GDP, but it is also going to create a job opportunities. So here we have the infrastructure fund. So they use only for the developments like airport, roads, communications, rail infrastructure. When you're going for the venture capitalists, it refers to the funding offered by the investors for the startups or small business where there is a very high growth potential they are able to find out. So high net worth individuals, they come on down the VC in order to make a very high returns and high risk too. And angel funds, which also coming as a type of a venture capitalist where manager funds pools of money for several angel investors and they stop. So you can see minimum funding is there from 25 lakhs. It has to be done on it. Another category we have called as social venture funds. The companies are aimed at making the profit and solving social as well as environmental problems, even though it is like a complicated investments, but many people use it as a business model. These are the funds which comes under the category 1. So when you are talking about the category 2, here it is going for the debt funds or private equity funds for which there is no concession or specific investments are given by the government. So here we talk about the private equity funds. So it is a collective investment scheme that is used for making investments in the several debt and equity investments. So here we have equity investment, you have here debt funds, and you have the fund of funds category coming over here in category 2. So debt funds, investments in debt instruments of listed and unlisted companies, they make too in this category. So here they have, which is having the low CIBIL score companies, and usually they want to take high risk. They invest onto the debt funds, they do it. And therefore the companies which are having a very huge growth potential and good corporate practices and good options for the debt fund investors, they fall under this category. Other one is fund of funds investments that you can make. The strategy of investing fund is to invest in a portfolios of others AAF instead of making its own portfolios. So in category 3, we have where they use advanced trading options they use. The funds which are intended for short-term returns and for no specific incentives are given by government under this category. So here we can find the hedge funds. So the hedge fund peoples, what they make is they collect the money and invest onto the debt and equity markets, both on national levels they make, and follow a very aggressive strategies in order to make an higher returns, and they have their higher expenses also in the hedge funds they have. And this private investment public equity fund, it refers to the practices of private investors as mutual funds are large institutions. They buy their shares at a very low market price, they do it. So these are the category 3 fund. So when we are taking the geographic part distribution, we can find how these categories are getting developed. So Mumbai and Bangalore are accounting for 75% of AAF. You can find out over here. Mumbai is accounting like for 2/3 are doing over here. And in category 2, you can find Mumbai-based funds are there. And category 3 AAF, you can find Bangalore and New Delhi are more likely to enter to the category 1 AAFs. So these are the 3 categories. On the geographic locations, you can find 62% is a holding by Mumbai, and next you can find Bangalore, and next you can find New Delhi, and the rest of the areas where the AIF distributions are in a percentage wise. So this AIF regulations has been introduced in May 21st, 2012. So an AIF means any fund which is established or incorporated in India in the form of a trust or a company or LLP or a body corporates. So which is a very private pooled investments vehicle. So they collect the funds, whether it could be Indian or foreign, they collect the funds according to the investments and defined investments policies they invest. So it is not covered, as you say, in mutual funds regulations, it's not covered, or collective investment schemes regulations or any other regulations on the fund management activities. So it comes under the AIF regulations we have. So we can find this industry is growing at 25% CGR and between 2022 and 25, which is led by wealth managers providing AIFs products as an alternative to high net worth individuals, family offices, and insurance firms are investing on it. So Asia and the emerging economies, particularly when we talk about India, we can find a next wave on the alternative growth strategies. So who are the investors over it when we take? So we can find the HNIs, as we told, they are the investment family offices, banks, insurance companies, pension funds, AIF fund of funds, they do it, and financial institutions, government bodies, sovereign funds, placement agencies, and other gatekeepers, they do it. So what is the minimum investments that I need to make for an investments over it? So if you take for the angel funds, you can take about 25. And if you're going for AIF, so you'll be making about 1 crore that you should be having it for making your investments. So these are the few terms that we should be knowing it when we are entering into the AIF. About the sponsors. So sponsors, you say their contributions are around like 100 million they need to contribute, and 2.5% is the continuing interest by the sponsor or the manager should be having it. And the minimum corpus is INR 200 million, which is when we return contract, and it is an open-ended fund. Any redemptions that are being made below this level, so the fund manager has to retain, has to restore it, the minimum corpus within the 3 months. If they are going to fail in, so it will be mandatorily redeemed. So this is a condition of maintaining on the minimum corpus. So when we talk about the minimum investments part, if you're going to make as a lump sum investment, the first lump sum investor, when we take, they'll be doing for the 10 million crore, they need to do it. And redemptions, if it is going to follow from the minimum amount, again, they need to regain it. So raising from the qualified investors, they can raise the funds from Indian, foreign, or non-resident, they can raise the funds. And foreign investments are allowed in this by 50% ownership should be provided by the Indian citizen. That is the conditions we have. So what is the maximum number of investors that I can have it in these are? It is up to 1,000 members they can have it. And they can, in the period of it, if you take the 10-year period, we can talk about it. It's for category 1 and 2, which is like a closed-ended funds, and the period would be of 3 years. And if you're going for the category 3, it will be as an open-ended funds. So these are the various terms that we should be knowing it before entering into an AIF when we are going to sign about it. So why this growth of private equity, which is an important class in AIF when we talk about it. So private equity funds managers has a second best fundraising in the industry. So as we know, more Make in India products are becoming around and more private investments are coming on this field. So it is being carried out in a larger and larger financial transactions are happening around it. So funds has increased their distribution and continue to deliver higher returns than any other class when you're talking about on private equity. The volume has been grown as so much global level on this private equity transactions in terms of mergers and acquisitions. So according to this Harvard Business School, they say it as 20% are the equity transactions which are happening at a global level on the mergers and acquisitions. When we talk about the private equity markets in India, we take nearly 57K Indian startups are launching onto the day, and 1,000 and odd on the mergers and acquisition deals are happening between 2014 and 22. And 131 billions of fund being raised between these years, 2014 and 22, and 5,000 and odds for the funded startups are in India, and internet companies are being increasing, and the valuations of the startups are very higher, and investor participations in the startup funding are 9.3K, and more than 100 plus unicorn startups are there with this. So there is a very, very huge market we are able to see from this figure, from this snapshot. So there is a very higher potential to earn a returns in terms of this transactions being happening. And it would be a very good diversification and complementary when you're considering onto the equity portfolios. And it is a wider investments universe because you can invest onto the unlisted markets on it. So what is the structure here? So in private capital, we can divide it into called as an equity. The other one is called as an debt. So equity where you provide your capital, and here the debt you provide it the capital for the loans you provide it on it. So it is an asset classes for investing in public and non-public companies or physical assets such as real estate that you provided. And majority of the substantial, there will be a stake in the company, and they try to exit this private. Yeah, the private equity people will exit within 3 to 5 years. When they look for an IRR of 20 to 30%, they try to exit. So here, when you talk about the strategies, about the structures, they have two structures. They have general partners and they have the limited partners. So general partners are the people who manage the funds and they make the investment decision. So coming to the limited partners, they have a very limited roles on it. They play passive roles and they are an outside investors, and they do not involve in the management of funds, which are taken care of by the only general partners in terms of the structure. When we take about the strategies, there are leverage buyouts and venture capitalists are there. In leverage buyouts, you can find the borrowed funds are being used to buy an established company here. And in venture capitalists, when you are going to invest into the companies that has not been established yet. So these are the two strategies that a private equity people follow it. And types of LBOs, we have it buyout and buy-ins we have. So current team, what they do, they purchase and runs the company, we call it as buyouts. And buy-in is the current team will be replaced and the acquirer who will be running the company. These are the two in LBOs we have. So venture capitalists, we have various stages. When we come on the first stage, we call it as formative stage, where we have where there is a huge potential, growth potential over there. In formative stage, angel investings are there, which is an idle stage where I have an idea, I need to develop it. So angel investors comes over it. And in seed stage, where I need to make my product development and do my market research, where the seed stage happens in. And early stage, when I'm moving into the operations, production and sales. So these three stages comes under the formative stage. Later stage, when I want to commercialize a product and I want to sell before the IPOs, then I come into the later stage. Mezzanine stage, we preparing to go for the public. So these are the three stages where you can make your investment of it. When you're coming for the exit strategies, as I told, for 3 to 5 years, these private equity people will be there and they try to exit out. So what are the exit strategies? They can form it of trade sale. I can sell it, the firms to the competitors. I can go for the publics through an IPOs I can do. I can increase my leverage to the recapitalization and I can sell it to another VC. I can do it. Or in worst case, the company is not going to do it and I need to write off and do the liquidations of it. So these are the types of PE and the company structure that you can see over here. From early stage to later stage, what is the typical investments and type of the private equity and the descriptions and which are the areas. So first one, when you talk about it from the venture capitalist, you can find 50K to 5 million, it is over there. And they invest on the early stages and where the cash flows are negative and requires the convincing marketing potential, which is not proven. So we can take some of the industry that we are looking on, life science, technology, and software. When you're taking on growth capital, it is small and mid-tier, they look, where the investments in equity and debt investments for the working capital or capital expenditure, they do it. And mezzanine finance, you can find on the manufacturing, on consumer products or real estates. and leverage buyout on operating company with a significant amount of borrowed funds to create value by realizing the opportunities and improving the efficiency. You can find an industry, consumer products or food manufacturing, you can find out. And it is a distressed buyout, which is of from 2 million to 200 million over there. So these are the typical investments they do for equity on debt securities, which are financially debt securities of financially stressed companies you can find, where there is a corporate restructuring or turnaround is required in this. So how does it operate? When you take, I told about the structure is like limited partners, and we have general partners over here. So here the general partners, they receive the management fee. That is a 2% based on the assets under the management. Apart from the management fees, the general partners receives a performance fees also. The investment fee or carried investment fee based on the realized profit, which you can see here, that is 20% returns on their investments, that is on the profits they have it. So generally the performance fee will be paid only if the returns are exceeding the preferred rate. So example, when we take the general partners has 18%, that is the IRR, we are getting about the 18% and the hurdle rate is 8%. So the limited partners, what they would be getting is 8%, and the general partners would be getting the next 2% out of the 10%. So it is 18 out of it, 10% would be remaining it. And the 10% will be shared between like 80 and 20 between the limited partners, and the general partners, they will be turning around. So these general partners would be getting around 3.6% return, and limited partners would be getting around 14.4%. So this is a structure like how the private equity and the GP and what is the management fee and how the deals are being made. So it gives you an idea how it works. So these are the VZ and PE values of the investment trend in terms of growth, buyout, startups, PPE and credit investment. You can find the growth is 5x. In 5 years, it has gone up in V market. So how to make investments in private equities? First, you can make your direct investments. So you can participate in funding round. Second, you can participate to the investment on private equity funds you can do, or you can do it on the fund of funds, you can do it. So there are huge growth and improved efficiency over there. And due to the digital India transformations and the new markets are being created, there is a very huge opportunities to include over there. The other category is called as an hedge funds over here. And this comes under the category 3 of AIF, which includes a fund of funds. And these are unregistered private investments partners that they have. They trade with the different strategies. They have like events, relative, macro, and equity hedge. They do it with those relative strategies. Even when we take, there is a short term, they are able to find out the pricing differences, inefficiencies between due to the bankruptcy or acquisitions or merger or restructure, they try to do it. Or relative between the stocks and bonds of the relative company, they are able to find relative securities. They try to make out the money on it, or the currency, fixed incomes, interest rates. And in equity, they can do like derivatives, short and long positions they might take and do it. So here you can find it is again the partnership structure they have, and the fees is 2% they provided, and profit sharing would be like 10 to 15%, and investments about 1 crore. And there's a very high risk onto this investing on it. These are the very few active hedge funds that you can find in the market. You can find it. Next options, we have it called as a real estate. As you know, there is a very huge potential for a longer term return, and you have the rental income, diversification benefits, and inflation hedge. Here we can divide it into called as a debt and equity. We have in debt, you can talk about the mortgages, mezzanine debt you can have. And equity, either you can have a direct ownership of equity or an indirect ownership of equity you can take, and prior trades are there. When you're going for a public, in debt, you can find MBBS on like residential and commercial. You have collateral mortgages, obligations, mortgage RIAs are there. And when you are taking on shares, equity part, when you are talking about in public, we have the listed REITs, we have mutual funds, index, ETFs. So there are larger opportunities are there. It's not only that you need to go and invest on the physical. You have they're very huge on equity oriented and a debt oriented. You have where you can make participated either direct or indirect. You can make, if you're going for REIT, you can use mutual funds, real estates, and the issue shares. There are opportunities on this platform also where you can make your investments. Okay. So these are the basic residential properties, commercial, real estate brings. You can divide it into private and public, equity and debt, and you can make your investments. Coming to the commodities, are many people are aware about the physical commodities, and we have commodity derivatives, and we have like equity. So where you're looking for a collateral yield, price, roll returns, you can make your investments. And coming to an infrastructure, this is also a one class of investments that we have. And here there will be a real capital intensive and which is a very long lived. These assets are intended for the public use and for essential services. We take about example, you take in airports or healthcare industry, we can use, and we can divide it like for economic use or for the society use. We can take it in terms of economy for transport and communication. In terms of society, you take education and healthcare. And on development front, you can have brownfield assets or greenfield assets. You can make your investments onto this. So this is on the infrastructure sides. So here we have given a snapshot like of from HDFC AMC assets, which is of category 2, and how they have made their portfolio construct. 50% they do in venture capital, balance in private equity, and it is capped up the corpus of 30%. And investments in 50 VCs or PE funds they are doing over it. So how the returns are gradually increasing over the VC and private equity funds are given over here. So how many listed and unlisted companies, how many funds are there? These round ones are the schemes which are there, and what is the return that we got? It is about 39.5% that you got in venture. Equity unlisted, it's 12.6%. And equity funds listed and unlisted, 75.1 that you have it. So based on the tax classifications, you can invest onto the AIF funds. There is no pass through for category 1 and 2 that you don't have it on the tax aspect all. So alternate investments, they have a very low correlation when you're comparing it traditional investments, and which will provide certainly the benefits of the diversification and for a higher returns than the traditional investments over a longer period, and they are less effectively priced and may offer the extra returns because they are illiquid and often used for leverages. So it's your turn, people, to add in your portfolios or participate in these alternative investments and make a very good return. So thank you all for patience listening for till this time. Thank you very much.
Thank you, Dr. Subhashini. Thank you so much. Yeah, there are a few questions in the chat box.
Okay, ma'am. Okay.
And we invite the participants to ask also. They can unmute and ask questions.
Okay, ma'am.
Can you see the question?
Investment, yes, ma'am. So land is a physical assets. Yeah, that's why we don't neglect the land. Yeah, but there are other forms of investment, as I told, in real estate. So you can take those form of investments, as I told, which will beating your inflation, and it will provide a better diversification. Are the regulations for equity investment sufficient? There is no control over IPO pricing. Sorry, we cannot comment on these regulations in this platform. Yeah, so might be you can put your views. We can take it across. So longer investments are always safe, and you can invest onto these startup companies which are having a very huge opportunities are there. So that's why we say you can invest onto the private equity funds. There are much larger opportunities than the established companies.
Madam, for my first question, you have not answered, madam.
First question, sir. Yeah.
See,
1 minute.
the
sir.
bank deposits do not give good returns. They don't beat inflation. But a
Yes,
large
sir.
number of persons are going in for bank deposits only.
So
And
it's
interest is also subject to tax, madam.
yes, sir.
So
So any investments, as I told, which is not the real return, we need to calculate, sir, after inflation. If you say the fixed deposits are like, it doesn't beat your inflation, right, sir? So how it would be a better option? Nowadays, many people are moving around from fixed deposits. Many people are moving. Only when you take the people who are in the old age groups are finding that fixed deposits are so convenient. But once they realize and calculate all these, so definitely they'll be coming out of the fixed deposits, sir. I don't say it is required. Sometimes when you want, yes, I need it for liquidity purpose, I need to have some portions on the fixed deposit. Surely it could be included in your portfolio, but it is not for a long term. That's my answer.
okay, for fixed deposits, the government need not impose tax, madam, income tax. If the interest exceeds a particular limit, tax is imposed. At least they can avoid.
Yes, sir. It could be taken across because we have the income tax slab also, right, sir?
Yes.
So based on it, yeah, you can get exempted too.
Instead of going for a very specific thing, no, that's why they're revising the slab actually. I think the current budget also, I think Mr. Muruganathan, no, Madhav Kumar, I think they have plans to revise the slab, if I'm correct. But they'll not, like you suggest, they'll not go to the nitty-gritties, like specifically to give some concession on interest.
On deposits. Yes,
yeah,
sir.
yeah, yeah.
That they
Correct.
cannot do it, sir.
Correct.
And we see here, as I told, persons who are investing on fixed deposits are not in the age group, probably like from 30 or 30 to 40 or on those age, right, sir? So you can take the age groups who are investing on. So might be some concessions are given on based on it. It would be better, sir.
Your voice is not clear.
Yes, sir. Is it clear, sir? Yeah. Okay. I think they should be giving for senior citizens. Much more concessions should be given on it, sir.
Madam, 50,000 is deduction is already given. Already there is a concession for senior citizens.
Yeah, correct.
Yeah. But you are claiming for the fixed deposits taxation,
more
right,
interest
sir?
rate for senior citizens also.
10,000.
Yeah.
Non-senior citizens 10,000.
Yes, sir.
Right.
Yeah.
Madam, I have a question. Like, there is a concept of FIRE, FIRE. That is
Yes,
financial independence, retire early.
Retire early. Okay.
Especially since the topic is on for new age investors.
Investors. Okay, sir.
You have any comments on that particular concept, madam? FIRE.
On FIRE.
So that is financial independence, retire early.
Or retired early.
See, the idea is, suppose 45, 40 age group, that people, they're comfortable, they earn good money. Normally they do one thing, they'll come out of their job and, they start doing, some options, in earning money. I think whatever options you put, that also nowadays it is getting popular actually.
Popular. Yes, sir. Yes, sir.
Yeah.
But I have not touched those areas. It's
That's what that FIRE is a very famous terminology nowadays.
Surely I'll look into it and I'll go through it on it, sir.
Okay.
Sessions I'll try to bring out.
Okay.
Yes, sir. Thank you for highlighting it, sir. Thank you, sir. It will be for my study, yeah.
Yes, correct.
Yes, sir. Thank you very much.
Any other questions? Okay. Thanks, Vandana. I think you set the stage well, and I think you introduced the speaker also nicely. And
Thank you, sir.
yeah. Dr. Subhashini, in fact, like, the topic you've taken,
Yes,
it's
sir.
a very critical topic.
Okay.
But one of our participants was mentioning, Muruganathan and Madhav Kumar, I think he asked some high-level questions, even he talked about economy, everything and all. But that's nice of him, actually. But you made very clearly about the investment option for new age investors. You gave a story also, telling three category of people, but ultimately you conveyed the intention is the thing for
Yes,
any
sir.
investment, like
Investments.
what you have to take.
Yeah.
Suppose low age people or millennials, they'll try for some focus. Age people, they'll suppose 50s after 40s, they'll intention will be to save for retirement.
Yes, sir.
But and you also put that the three mantras, that is a very important one. I think you have to plan early. I think many of us, I think we fail over there. I think only late realization we'll try to do, but sometimes it may not be thing, and we have to do regularly also, long term.
Yeah.
I think that three rules are very applicable for everyone, especially for the new age investors, millennials also. Because many times they realize only after 40 or 45, at the time it will be very late for
them to do it.
correct. That you nicely.
And they don't do it regularly also. Just they make one time and they forget. When the market falls again, they feel, oh yeah, I have lost the money. They never re-enter into the markets when there is a fall also. So we have to watch on it and divide our investments accordingly.
No, actually, my experience or understanding, mainly many people are doing for some investment only for saving tax.
Save taxing.
Not anything else. No, that's the thing. Otherwise, whatever the money, they'll try to invest in something. And, of course, investment in real estate, buying a flat, everything and all is fine. Shares also, many new age people, they do.
Yes, sir.
But you touched upon other areas, like, I think it's should open the eyes, like, but again, you touched upon the GDP growth, how it's correlate with the investment pattern, and India growth areas, like you touched upon, the IT and other things, even banking, all the areas, growth prospects are very
huge,
very, very huge. So obviously, the investment options also, it is correlated actually. And you again touched upon briefly and nicely about the financial assets investment and the physical assets investment. But you spelled more on this alternatives.
Yes, sir.
And
because
I think
these are the investments which are growing right now. So
correct.
we should look onto it, not only on traditional investments.
Correct.
Look on it. Whenever they come out an article, they can definitely look on it and what it is about.
Yeah, correct. And you again clearly put in three categories. And the investors and the terms, and growth, especially in the private equity. I think you elaborated all the areas focused on, like, the alternative investments, or it's a modern thing comparing the traditional thing. So in nutshell, I think you justified your topic, ma'am.
Yeah, thank you, sir.
Even for me, I got good inputs on this. So thanks a lot for your time and efforts.
Thank you, sir.
I think it's 1 hour session. I think definitely the participant would have got benefited. And I think one point of time, I think it crossed in Zoom itself about 105. Okay. So thanks a lot for all the delegates. I think you attended and with that. So thanks a lot once again. And last but not the least, thanks go to my CMA back office staff for their coordination with you from the early stage and till the current level. So thanks a lot once again. Anything more, Vandana?
Nothing more, sir. Thank you, ma'am, for the insightful and informative session.
Yes.
Thank you very much, ma'am.
The participants would have gained immensely.
Yeah,
surely.
Correct. And it's a food for thought also.
I recommend everyone to make investments.
Correct.
Yes.
Okay.
Okay. Thank you so much.
Thank you. Thanks a lot, sir.
Thank you very much.
Bye.